Awesome. Well, we're excited to be here today on the Trax Freight Market Report. We have a boatload of amazing data to cover. We've pulled out the highlights, and we're going to have Steve Bita kind of break down what matters from the incredible quantity of data. And, to his point, we're, yes, pulling out what we've identified as some of the most important data points, and also what has changed in the last 24 hours, in the last 7 days. There have just been so many things, and we are seeing such an incredible rate of change as news turns over, as geopolitical events transpire, and all of that. So definitely going to look forward to his perspective on some of that as well. So I'm joined today. I'm Joy Yule. I'm joined today by Brianna Coleman, who heads up marketing at Trax Technologies. So hey, Brianna, glad you're here.
Hey, thanks for having us.
All right, you're going to facilitate. And then Steve Bita, as always, super stoked that you're bringing your expertise to this conversation. So tell our audience a little bit about who you are in case there are listeners that don't know you yet.
Sure. Well, thank you, Joy. Steve Bita, Executive Vice President of Customer Engagement and Advisory at Trax. Been in the industry for many, many years. That's where a few gray hairs growing there. Seen just about everything there is, and spent a lot of time in various roles. Probably starting my career more in technology enablement around supply chain, and then moving into various automation, procurement, and operational roles, and then finally ending up more on a consulting side. So accumulating all that knowledge and trying to bundle that all up and read the tea leaves of the market and provide input into our customers and how to improve their overall programs and create more agility in their own supply chain. So happy to be here today.
Agility seems like the name of the game. So
you'll hear that word a few times.
So even as we put together all of the data this month, I feel like we're rushing to get it out the door, because as we were publishing, things were changing. So I feel like we need to very quickly deliver this before it changes again.
It's true. I mean, by the time the ink dries, something comes up. It's really an interesting time right now. You have to really be sort of on your toes, right, in terms of listening to the market and reacting appropriately. So I totally agree, Joy.
So thank goodness for technology, and thank goodness for experts who can decode and wade through the vast amounts of data that we have access to. So we're excited for you to kind of unpack the highlights of this month's Freight Market Report. So for those of you who don't know, Trax Technologies publishes this report every month. It's a huge data harvest of things that are in the freight market space, supply chain data, all of that. And then Steve Bita himself actually goes through and provides expert commentary. Essentially, what does this mean? So this is a subscription-based asset, and you can absolutely sign up to receive it on a monthly basis via email. So we'll make sure you have access to that link, and Brianna's team will ensure that you can sign up to get that handy asset, regardless of what your role is in supply chain, leadership, transportation, all that. It's extremely useful information. So Steve, kind of kick us off with some of the things that have very recently happened related to kind of these trade deals and the way it's impacting the way people are maybe holding off on inventory, the way that they're, let's not use the word hoarding, but thinking about, keeping stock and all of that, and especially the trade deals with the EU, Japan, and South Korea. So give us kind of the high level of what happened and what the impact of that was.
Well, it's interesting because I feel a bit like a manic depressive person. You get these wins with the EU, Japan, and South Korea, and then you find out about the sweeping tariffs that are going into effect, and a little bit different with Canada. You get some other things going on there, but point being is there's a lot of uncertainty, some good news and bad news. I say bad news only in the terms of uncertainty, right? I think things will get done. Deals will be cut, but the timing for which they get done and how long it takes is an unknown. And that's resulted in sort of hedging, if you will, using inventory to hedge, preceding a tariff increase on an import. And that hedge has created inventory volatility, certainly on the upside for the last few months. And now that inventory needs to burn down. Until that inventory is burned down, obviously there's a cost to store that inventory, which any supply chain management, any supply chain itself wants to keep inventory at the appropriate level, not too much, not too little, but it's definitely on the high side, which has impacted warehouse capacity. So someone is storing this either mid-mile or at the endpoint. So if it's being stored in transit, then it's probably being stored with an LSP, possibly on a box or a container or on a truck or something. But if it's made it to a destination, then it's being stored in a warehouse. So that's put a constraint on that as well. All of this is a result of tariffs. All of this is going to eventually stabilize, but until those deals are done and until we see more of them completed, you'll see certainly the administration putting more pressure on the countries that haven't cut the deals yet to do so fairly quickly. And how long will that take? Hard to say. I think with this new sweeping reciprocating tariff, it'll wake up a few more that want to come to the table and get things resolved. I mean, we have a lot of really good trading partners. On what's interesting, we'll talk more about this a little later, is the incredible investment in U.S. manufacturing that I think the market isn't appreciating today. If you look at the market today, we had some bad news this week. If you read it from a short-term perspective, but long-term, I think that investment will pay off, and there'll be more onshoring and some changes in supply, where supply comes from in the long term. Okay, so that's kind of how I read the LMI. This is one element of the LMI, and that is the index is a composite of inventory, warehouse, transportation. But certainly the inventory is the one that's standing up on the radar as a red flag for the short term.
Can you explain the difference or the nuances around Canada? I know it's
there's some other reasons. So normally trade tariffs are due to imbalances of trade deficits, right, one way or the other, and artificial inflation of pricing or currency, which is primarily a China thing that we're trying to work through. Canada is a little different. There's some penalties being enforced with Canada due to prescription drug flow from Canada that they're trying to curtail. So that's a little bit different issue or rationale behind a tariff than what we typically see with most of the deals being cut. Usually it's a trade imbalance. That one's got a little bit more motivation behind it that's related to illegal trafficking or trafficking of controlled substances. So Canada's a little different. Their neighbor, I'm sure it's going to get worked out. We had some issues with Mexico, if you remember back, and that got worked out. But most of these trade deals are certainly due to trade imbalance and fairness of trade between the U.S. and the other country involved in the trade deal. Okay.
Would you say that these tariffs and the hedging of the inventory impacts any industries more than others, or is there consistency there? Or I would think that some industries can't hedge inventory like others can, right?
Yeah, I think, well, you have shelf life problems, right? So you have how long does a product live on the shelf before it becomes non-usable, non-saleable? Some industries like retailers have another way of distributing that product through a lower cost mechanism, right? I'm sure you're aware of that, right? So you discount it and you sell it through different means, but nobody wants to do that purposely. That usually is a result of a product that just doesn't become as popular anymore, and they have too much inventory and they want to sell it off. Pharma is completely different. Obviously, pharma is very sensitive to not only transit time, but shelf life and all those things. So once products become expire or stale, they're no longer valuable. So I think that's a good example of why different industries have to handle this differently. I think the other thing is you're talking about very specific countries here and trade deals that are happening on specific trade sourcing countries and lanes. So depending on where you're sourcing from, if you're single sourced, you may see a higher impact if a deal is cut or not cut on a specific country of sourcing, that you're putting more eggs in the basket in one country those companies that have a distributed set of suppliers that are less impacted by one probably have a better way of navigating this more comfortably by using alternative sources for supply side inventory than others. Of course, everyone wants to consolidate suppliers and everybody likes to consolidate carriers because of pricing advantage. So it's a trade-off, but you also have to mitigate risk. And I would say in a market like this, risk mitigation is very important as well as cost. Okay.
Good question.
Great question.
Yeah.
Devil's always in the details on these things. And I'll tell you, the data really matters. Knowing where your supply is coming from, knowing the cost, knowing the ramifications of moving it from A to B and all that. Those are all the modeling that's going on to create the ability to predict the best next move in the chess game, so to speak, right?
Right.
And you hope you make the right one.
So speaking of, we do a lot of, in the monthly report, a lot of transportation and warehousing capacity, pricing, utilization rates, things like that. So all of those kind of projection numbers are impacted by inventory hoarding. So we said, the scarcity is tied to some tariff mitigation strategies. So there's a supply demand imbalance that could drive up storage costs. Do you think that's true? How do you think that kind of supply demand is going to shake out? Do you think tariffs will still be an impacting factor there? What's your take?
Yeah, well, here's what I see based on the trending. So I like to look at a trend data point as well as the current data point. And as the report shows, we're looking at fell by or changed by. So it's really a matter of not only the direction of change, but the rate of change. Mm-hmm. Something that's changing rapidly is more concerning than something that's not changing as rapidly or moving as up or down, right? It shows more stability. I still believe that until I get proven otherwise, and I reserve the right to change my mind, especially in this market, but I still don't see a lot of movement in capacity and pricing on transportation. I see more of the move on inventory. I see that impacting warehouse. Now, what's interesting is I'm reading some things about companies or LSPs are less concerned about getting their asset is in terms of a truck or container back to the place where it needs to be filled, which tells you they're sort of hedging on less demand inbound once it's inventory until it's burned off. So what's happening is we don't show this on the graph, but you also have the actual asset of the truck or the container that's being hung up if it's being used as inventory, and that has cost too. So carriers, LSPs don't just allow you to use their assets as inventory management. You can get away with that during transit, but they expect you to unload that asset once it goes to its destination. So you're seeing a blend of probably cost and increases in the use of the carrier or LSP's asset for inventory management, but you're also seeing it obviously in the warehouse, which is measured, is one of the measurements here. So again, short term until this inventory is burned off, it'll remain high. But I don't see up or down fluctuations in capacity and pricing and utilization and capacity on the transportation side. There is some fluctuations, but I don't see it as material as inventory right now.
Okay. Let's talk a little bit about the Fed and consumer sentiment and how that's kind of impacting all things. I kind of want to start with this one and then maybe go back a little bit to consumer demand and inflation,
Sure.
if that order makes sense to you.
Sure. Yeah.
So let's start here. Talk us through kind of how we're feeling about the Fed's hawkish stance, the manufacturing boom, some of those dynamics.
Yeah, I find it interesting that probably none of us have degrees in economics, but yet we're so influenced by some of these numbers and how they influence contracts, length of contracts, and pricing, really in inventory and really everything we do. So you have to know how to read the tea leaves, so to speak, on the economic side. What I find interesting in these numbers, in again short and long term, I think. Listen, the Fed has been very clear about their hawkish stance on interest rates. As noted in my last update, I don't necessarily agree with that, but I understand that they let inflation get out of control. Sort of, I say they didn't really cause it, but inflation got really high for a long time, and they like to keep it in the 2% range. So that may be the reason. There's some news that came out this week, again, hot off the press, that the job numbers are revised a bit in the U.S. There's a little softer job market that's going to incent lower interest rates in the September meeting, but the meeting was held this week and they held them steady. So in terms of that isn't going to change. I think in terms of the impacts on these other things, again, these type of things impact probably less short-term and more long-term, even with contracts. So you see the pricing index. When you negotiate a new price, there's a hedge in the negotiation about what's going to happen based on the term the prices are effective. If inflation is at 2.x and it's going up or going down, that gets baked into the contract itself. That's naturally going to influence pricing, and that's going to influence the cost to serve in the market, in the various markets for which you're using the third-party transportation logistics providers. So these things all tie together. The fact the index is up is very much an equation of inventory. Manufacturing is down a bit. I think that's a short-term thing. I think long-term, we've seen billions of dollars in investments in manufacturing that will eventually create a surge in more nearshoring, I guess, if you will, or U.S.-based manufacturing for U.S. distribution or regional distribution elsewhere. And again, I don't see transportation prices going up or down that much yet. I don't see any event that would create a volatility in that area. Continuing to watch fuel. Fuel's kind of not been that much of a conversation lately either, but that could change with geopolitical events. So that's kind of my read on the benchmarks. But we'll have to watch closely what happens with the Fed's decision coming up, because that will impact contracts. Going into consumer demand and inflation, inflation did tick up a little bit. That's going to go put a vote on the side of holding interest rates steady, right? So you got these signals coming in that are, going both ways. What we don't show on the chart is the numbers that just came in, I think today or yesterday, on the job market being a little softer than expected. What's interesting is GDP was up. Mm-hmm. So GDP came in higher, which you could argue that two ways. That's a good news thing, right? Everybody wants a better GDP. I think it came in at 3%, which is more than forecast. But it also creates risk for inflation because of increased demand. So, it goes both ways. So I can see the contemplation happening between these inputs and these numbers. But the interesting thing is the consumer, who's really a main driver of the economy, while they're more deal oriented, they seem to still be spending the dollar. Amazon, for instance, had the biggest Prime event in history. In fact, I was reading it's by multiple, it's like tens of percents, like not a small amount of increase. So people are really looking for deals, and if the price is right, they're going to buy. And so that's interesting, right? So inflation may be up a little bit, but consumers are still they're still purchasing, and I see other industries that are doing very well. GDP is up at 3%. So these are all supply demand things that we need to watch carefully as we come into the 2025 back to school or the peak season to follow, to see where we end up with some of these benchmark numbers going forward. But certainly going back to the very beginning, tariffs will have an impact, and we'll just have to see how quickly they get resolved and where that goes.
Mm-hmm. Well, it didn't scare people as much as maybe we thought it would. I mean, I just looked it up, $24 billion spent on Prime Day. I didn't even know it was Prime. Did you buy anything on Prime Day, Steve?
I did. I bought a TV.
You bought a TV. There you go. Was it a good deal?
It was a really good deal.
Okay.
Yeah.
Brianna?
And I was waiting. Yeah. So I'm your classic consumer. I'm a cheap guy, so I look for deals.
Good.
You know, but the point is there is discretionary income to spend on, and people are doing it. So, you know, there must be enough confidence in the economy to keep that going forward, right? So, no, they haven't had a negative impact. In fact, you could argue long term that we're playing a little bit more of a long-term game than a short-term game. So the fact the market's down today by quite a bit, does it concern me? No, it's just because there's some bit more bad news maybe this week, short-term, than good news. But I think for the long-term play is a good one. Okay, so it's just we got to get there.
Well, speaking of the long term, and I know you made mention of it, this, you know, manufacturing investments. Right. So I think that's an important thing. Maybe let's talk a little bit more about that and what it means in terms of long-term trends to bringing, you know, to, like you had mentioned, nearshoring. You know, what does it mean for supply chain executives who have kind of these larger, broader international footprints, to have maybe more of a centralization in the West or have some of those dynamics occurring?
Yeah. Well, you know, supply chain and transportation logistics is just fancy math. If you think about it, you know, back 30 years ago, you couldn't get a degree in these things. You basically got an operations statistics degree or a math degree. My point is it's all about mathematics in terms of distance, cost, time in transit, things like that, right? And maybe more lately, carbon emissions. Mm-hmm. So if you can move product closer to where it's distributed to the consumer, you obviously have time and transit advantages, reduced transportation, less carbon emissions, and lower cost related. That said, you have to balance that with the cost of manufacturing. That's the whole thing, right? Cost of the product. These investments to bring more manufacturing here, as long as they're done thoughtfully and done in a way where the ultimate cost to the consumer isn't increasing by a significant amount, because people don't want to pay necessarily more for a product unless it's really high quality and in an amazingly distinct monopolized market. And so if that could be done properly, then everybody wins. And you have more choice. It doesn't mean everything gets sourced in one place. It just means you have more nearshoring of manufacturing closer to the consumer to have as an option, versus today where there's a bit of an imbalance, as we all know, of where product is being sourced from and where it's going to. Okay, so simple math says it's cheaper, faster, more efficient, and less carbon emission if you can move manufacturing closer to the distribution or to the consumer of the product, the end point. But that has to be balanced with all the other factors like inventory, cost of product, cost of warehousing, cost of labor, et cetera, et cetera, et cetera. So that's why I say long term, these things will not only reduce complexity in the supply chain, give more options for supply, but honestly will de-risk some of the other factors in relying on more critical product areas like pharmaceutical or chip technology that are being sourced from countries that at any point some disruption could occur, and now you're facing issues. If we all remember COVID, and we were in some sort of just-in-time inventory strategy with chip manufacturing for automobiles. Well, that didn't play out very well when it got cut off. So that taught us a lesson about, yes, just in time is really good, but when you're relying on suppliers that are quite a distance from where the distribution is taking place, or manufacturing in this case, then you face the consequences of a disruption or disruptive event. Okay, so having good data is never going to hurt you.
Yep. All right. Yeah, I was going to ask about chips because that's all. I'm in AI, so all we talk about is the chips.
Yeah,
and the
lately
data centers.
it's not just the chips; it's the power to
It's the chips in the data centers.
the power to generate enough electricity to run the cooling systems in the CPUs. So
Whoever wins the data
next
center, the power center game is going to win the
Yep.
AI race. All right. So the last point that I just want to make sure we touch on a little bit here is kind of the rebalancing. So we've got, we talked a lot about disruptive elements today, and I'm so grateful to you for bringing a lot of those to top of mind, because I think you're right. I mean, there's so many things that have happened in the last day, in the last week, in the last month, that we need to be aware of, and supply chain professionals and executives need to be aware of. So as we look ahead, right, and you're making calculated projections and predictions, qualified ones, obviously, how do you see things shaking out as we forecast out into the kind of rest of this year and into next year?
So tariffs aside, which we already kind of, we sort of talked about, there's some timing there of this next wave of deals that need to get completed and stabilized there. That may take months, right? So that could easily take several more months. There's been a new shot over the bow that just went in effect today. So we'll see. In terms of tender rejection, tender capacity for transportation logistics, I still don't see any indications. We're going to get another LMI readout here soon. I don't see any. I don't see a major change in that as much. That maybe you can argue there's some shifting of control a little bit more toward a carrier, but I don't see any major changes in that area. So what I think we need to watch is, as this inventory is burned down, what's next? Because now you rebalance the inventory. I think transportation pricing, capacity, and utilization are fairly balanced right now. I don't see any major gap there. So heading into the peak season, which really starts, September-ish, going through November, we call peak, mainly around peak season for retail, right? Which is a lot of consumable goods that are coming in from usually non-U.S. origins. We'll see how that plays out, but I see continued stabilization in that area. I don't see fuel going up or down. There's some more stability now happening in that area. So it's really going to be a matter of burning this inventory down. What's next? If that rebalances, then we're fairly good shape. The consumer demand doesn't seem to be going one way or the other in a bad direction. I'm not going to paint 100% rosy picture here, though. There are some red flags showing, maybe not red, maybe yellow right now. So that's why I'm thinking the Fed will have to do something in September. I'm seeing more pressure that they're going to have to do something to create more investment capital, which would be lowering the interest rate on the borrowing capability of companies to invest in either technology or people, or manufacturing, or whatever the case, right? So, and if you want, I can give a recap of what I think you can do about it.
Yeah, go for it. I mean, that's great. Let's be practical.
Okay. So you're going to hear the same thing again, but I was talking to a customer earlier today, and I would tell them the same thing I'm telling you. So listen, I can tell you all day long that you should invest in technology enablement, data visibility, and the ability to adapt to changing market conditions or geopolitical events. But when I say that, usually I'm saying it in a way where you should do that now in case something happens. Don't wait till the thing happens and then try to invest in that kind of capability. So everybody's got a digital transformation roadmap that they're working. Many of those digital roadmaps include some AI capability and enablement in those roadmaps, right? Because that's the next thing, and especially in the area of predicting and forecasting. But I would tell you that given what I see in the market today and the volatility that I see and the uncertainty, there's never a better time to have information accurate information, relevant information, and recent information to navigate the changes that are taking place in the world today. So if you're late to the game, then you better catch up. If you're getting close, then that's probably good. You better get it wrapped up. And if you're ahead of the game and you're well positioned to have the information as you need it and to use it in an operational way to govern the execution and decisions you need to make, then you're in pretty good shape. You're looking at all this going, okay, this is another day in the industry, and I can deal with it. It may have a short-term up or down impact, but I'm be able to forecast that and react appropriately to those changing conditions. So that's the way I see it. And I would, and again, instead of arguing from a point of preparedness, I would say you're in it. I haven't seen the industry like this. Let's put COVID aside and the recession aside. There are many, many variables coming at these executives in supply chain and these managers, and it's difficult right now to navigate. I will tell you, for sure.
Well, we're glad we have experts like you to listen in on. My gosh, you're well spoken. Yeah, I feel like I'm hanging on every word. Yeah, that was fantastic. We appreciate that so much. Yeah, chock full. I'm gonna have to rewatch because you said so many great things, and I appreciate all of your insights. Brenda, you want to give us a little overview of how people can sign up? We'll make sure we drop the link, but give us a little how often people get it. Make sure they get access to this.
Yep, we'll drop the link to subscribe to the monthly freight market report. We release it at the beginning of every month. So the July report will look back at data that was pulled from the month of June. So subscribe and you'll get it straight to your inbox every month. And then you'll have a monthly live with our expert, Steve, to look forward to as he provides his expert commentary on the report.
Awesome. Well, I appreciate you both being here. This was fantastic. We'll make sure that we splice it up and sprinkle it out through the month, and people can kind of get quick hits of all your great insights. And we look forward to seeing you again next month.
Yes.
Thanks, Joy. Thanks, Brianna. Right. Never a dull moment.
No, never a dull moment.
Sure isn't.
Thank you.
Thank you.